Good Monday morning, Market Chameleons, and everyone join us for the first time. Welcome to Market Chameleon's pre-market show. We do this every day during the trading week, 9 to 9:30, and there he is, the King Chameleon, Dimitri Pargamonic. How you doing, Dima?
Good morning, Will. How are you?
Excellent. Excellent. So you want to
How's your
start with the
weekend?
disclaimer? It's up and running.
Sure. Before we get started, everyone, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. Real quick, Will, I just realized I didn't have my mic plugged in. Let me just do that.
All right. Well, you sound okay. For those who didn't hear last week, Dimitri and I are doing the IBKR webinar tomorrow at 2 p.m. I will put that link into the Zoom. Also in the Zoom is the link, or excuse me, also in the YouTube chat is the link over to the Zoom meeting. We are having a Q&A day today. So if you have any questions, please come on over and ask them live. We find it super helpful if these questions are asked live. If you are a little intimidated about doing it live, type it into the chat and we will try to get to it the best we can. With that, Dean, are you ready to go?
Yep. So let me just share my screen. How does that sound?
Sounds good.
Okay. So what we'll do is we'll open up today for questions. Like I said, tomorrow we're going to do that IBKR webinar on butterflies. So, butterflies I'm going to go over tomorrow. But if you guys have any other questions, please, put those either in the chat or come over and ask it live on Zoom. What I'll do today is we'll go over the pre-market report. If you guys have any questions, we'll go over that while we're waiting for questions to queue up. I'm going to go to the options chain, maybe set up. I think there were some questions from last week we said we would cover. Somebody wanted to go over like a double calendar spread. I think we invited him on the show. Maybe what happened with he didn't have like a mic. So I'll just try to kind of go over the calendar spread and the double calendar spread, kind of just set it up, run a payout diagram, look at the different risk rewards, what your outlook could be using that double calendar spread. Of course, if you can come on a show, that would be even better, because this way he could tell us what he's looking, what you're looking at, kind of your thought process. If you used it before, what worked, what didn't work, that would be great. So let's just move on to the pre-market report. And then you tell me, if there are any questions. If not, we'll do the double calendar spread. Sound good?
All right.
All right. So this is the pre-market report. These are stocks that are trading in a pre-market hours. We have the most active stocks. We have biggest percentage gainers, biggest percentage decliners. I'm going to come down here. I see 61 stocks made our percentage gainers list, 153 on a percentage decliners list. So right now, from that perspective, it looks like we're lining up for a more bearish opening. Let's take a look at the S&P 500 stocks, see if we see a similar situation. So I'm going to go here in ETF. I'm going to pick SPY. By picking the SPY ETF, the S&P 500 ETF, it filters by the components in that ETF. So here we see 3 stocks made our percentage gainers list, 26 on the decliners list. So from that perspective, we still look, like we're setting up for a bearish opening. Based on this ratio. If you don't have questions, Will, I'll start moving on then to the options chain. Go over some examples. I think you're on mute.
Sorry about that. I still have the sniffles, so I muted it so we don't get a reverb. We did have one question real quick. Someone was asking, how can they see if there are any IPOs this week? Is there a way to look for new issues that are being listed?
We don't have like an IPO list. What we do have is, if there's let me take a look at the morning report. So if a new stock is listed today, like here's a new securities, these are in the yellow, then we list these securities in here. But if there's an IPO expected to come out next week or in a week, or we don't have a list of that, but you could find them for free, if you just search the website, the World Wide Web. But what we do is if it's being listed today, start of trading day today, it'll be on this list. So these are stocks. If it's a new options that is listed for the first time, you will list it down here. So DVD listed on the Amex. So they're going to start listing their options today. So that's pretty much what we have. But I think you could go to NASDAQ.com. They have an IPO list. The thing is with those sometimes they remove them. Sometimes there's changes to the date. So you got to kind of keep track of it if you want to look ahead of time. But these are not only equities, but anything. There, as you could see here, some of these are rights, some of them are going to be preferred stock, some are going to be ETFs, some are going to be closed-end funds. So there are different things that get listed on the stock exchanges, irrelevant of just IPOs of a new company, and you'd find that in here. Okay, and if you wanted to go back, you could kind of tab back down here. Does that help?
Yeah, that's good.
Okay. If there are no other questions, I'll start moving on to the options chain.
Sounds good.
All right. So one of the questions last week was a double calendar spread, right? And again,
I think actually it's Trevor. He came back. He was asking. It was a double calendar spread around earnings was what he was looking at.
Okay. So let me try to find one. I'm gonna go to McDonald's because I was just let me see when their earnings are coming. So their earnings are coming up, and on January 27th. So I'll do McDonald's just because I'm starting to write a blog. I was going to write a blog entry actually on just the calendar spread, but I'll take a look at the double calendar spread. And look, I'm going to assume what you're looking at without you coming over. I'm just going to make assumptions of what you're trying to do. It's always helpful just to come over and explain what you're looking at. But here's McDonald's, right? The question was a double calendar spread around earnings. And we see earnings are coming up January 27th. And over here, these are the different expirations I could select. January 28th, this little E is telling us that that earnings announcement is going to be covered by this expiration. So you can see January 27th, they're going to report earnings. January 28th will cover that expiration. Obviously, all these will also. The options prior that expire prior to January 27th will not cover earnings, right? Because those options will cease to exist prior to the earnings announcement. So when we look at a calendar spread, you could go long calendar spread or short calendar spread. We're going to take a look at a long calendar spread. The idea behind it is we're going to buy an option that covers earnings. So that will be, let's say, on January 28th expiration. Okay. And then we're going to sell an option prior to earnings. And the idea behind that is, well, there are a couple things in your outlook. The idea first is that if I buy an option that covers earnings in January 28th, and since I'm going to do a double, I'm going to spread these out a little bit. But let's say I buy an option that's the stock's like 267 right now. All right. So let's say I buy an option that's 270 strike, a little bit above there. And then I'm going to buy this option thinking, okay, right now my thesis might be that the implied vols are a little bit low, right? So I think that it has a chance to go up. And since there is going to be an earnings coming up on this expiration, there's like this already built-in support for that option, right? So there's so much it could decrease because it still has this unexpected event. And as we get closer to the event, the demand for options will increase to, either play the movement or hedge your positions. So that's the first thesis behind buying this option, right? So a couple of things. First, we think maybe the implied vols are a little cheap and that there's going to be this built-in demand, and that demand will increase as we get closer to the earnings. So if that's our play, a calendar spread can help us if we think that in the meantime, as we're waiting to get closer to it, maybe nothing's going on. We might just sit here, or not move around a lot. And to finance this purchase, I'm going to sell an option, but that expires prior to earnings. So here I'm coming back to January 21st, and I'm going to sell this on the same strike, right? So I bought the 270 strike January 28th. I'm going to sell that option, the 270 strike. And this is, before we go into a double, this is a single call spread, right? So this is just a long call spread, long calendar spread, long time spread. So this is what it would look like. And you could see here that this chart plots it based on this first expiration, January 21st. And when we do a calendar spread, the tricky part is that you have two different expirations. So one time, when your first expiration comes around, that option will either be in the money or out of the money, right? It's going to go to parity. And after expiration, it ceases to exist. So you only have one option left. So really, this strategy itself will stop at that first expiration because this option will no longer exist. So that's why we plot the graph at the first expiration, payout January 21st. And we know, based on the stock prices, we know it will be easy to calculate the January 270 call because it's either going to be out of the money, which will be worthless if the stock's below. If the stock's in the money, if it goes above, it'll be worth the difference between the strike and the stock price, the parity. So that's easy to calculate. What's not easy to calculate is this next month out, January 28th, because it still has time value, right? And because it still has time value, it could be priced anywhere. The implied vols could go lower, they could go higher. So that one is trickier to price, right? And you have to estimate that because we don't know what the implied vol will be on January 21st. So we have to estimate it. And the initial plot is to say that the implied vol will be what it is today. And then you could change it. Okay, so right now it's just plotting based on if the implied vol remains the same. But we could, we could go and then into our historical data and create different estimates based on where implied vol moves towards as we get closer to the earnings. But let's leave it at this for now. And we could see here, when you do a calendar spread, you do have a kind of target price. So you have a point, like a calendar spread that you're using the same strike price. That strike price kind of becomes your sweet spot. So here we see 270 is the sweet spot. That's where you would maximize your return at that point. And why is that the case? Because at 270, if we close at 270, this first option that we sold, right? So we sold this for $1.71, would expire worthless, right? Theoretically, if it's 270, you don't get exercise, maybe like 1 penny below, expires worthless. So that premium that we sold that first one, $1.71, we would keep, right? because it expired worthless, and kind of we got to keep that $1.71 that we sold it for. And this other option that we're long will be at the money. And when the option is at the money, that's when it has the greatest time premium, right? So it's all time premium at the money. So your at the money options will be your biggest time premium. Okay, so that's why that 270 is the sweet spot as far as stock price goes, right? Then you also have that implied volatility component to think about. So if we look at it from this perspective, we'll say, okay, what if I'm doing a calendar spread, but I think that now I have this directional bias, right, towards 270, but you might think, I think it could go to 270 or come down to, let's say, 265. So I have two. So now you're doing a double. This is the double calendar spread. You're actually going to do, and I think this is what he's saying, unless he's saying like a ratio. I don't know if he means like a ratio, because people use these terms differently, but I think this is what Trevor, right, was referring to.
Trevor's on, so I don't think he has a mic. Trevor, if there's anything you're seeing which is different than the way you are putting together this double calendar, let us know.
So here's the second part to it. So I'm going to go now to the strike below 265. Buy this put. Wait, let me just make sure I'm on the right expiration. So I'm going to set it up. I'm going to go back to January 28th. I'm going to leave this initial calendar spread, and I'm going to now do another one. So I'm going to go to the 265 put. I'm going to buy this for $3.80. Let's say, so now, I got my third leg of the strategy. Then I'm going to go back to the same month, January 21st, and I'm going to sell the same strike 265 put. Okay. So you could see here, I'm just going to review before I run this, load the strategy. We're buying the call calendar spread, buying the 270 call Jan 28th, selling the 270 call Jan 21st. Then Jan 28th, we're buying the 265 put and selling the 265 put Jan 21st, right? And let's just, right now, we're assuming we're doing them all on the markets. I'm going to load that strategy. And what you see here now is you have two spots, right? Because you did two strikes. So you kind of have two potential sweet spots, 270 or 265. Okay. That's so it looks kind of like this. I don't know, what does this look like to you? Like cat ears or something? I don't know how you describe, but you could see that there's two kind of like points or peaks. And here, just looking at this strategy here, the risk reward doesn't look that great because I'm seeing mostly red, right? Like if you're looking at it, it's mostly red, couple green, but I'm going to change some of these assumptions right now just to kind of show you a little bit more. Because remember, first I did it all on the markets. So here you can see this market's pretty wide, 257, 338, midpoint 298. So we're assuming we just did it on the market 338. So let's just take off. If we did a mid-market, that's about 40 cents, right? So let's just say we were able to do a mid-market. So just to remove our purchase price by 40 cents, I'm going to say this call here that we bought for 340, let's say we got it for $3. All right. We did the whole strategy for like 298. I'm going to reload that strategy. So now it looks a little bit better. In this scenario, it looks to me like, anywhere between the strikes would be profitable, right? So as long as the stock at that first January 21st expiration is between the strikes, this will be profitable as long as the implied volatility on January 28th remain the same. But let's say we think that the implied volatility will start to increase as we get closer to earnings. So let's just take a look at this, because this is going to be one day. Well, we'll be a couple days away, right? January 21st will be like a week away. So I'm just going to take a look at another Market Chameleon. And we're going to estimate where we think these implied vols are going to be, because I think that they're probably going to start increasing. So we got to go back in. I'm going to draw ourselves a better diagram here. So I'm going to go to McDonald's, right? And I'm going to go to the earnings, historical earnings. These are the implied vols. So if we start a week 5 days before earnings, right? 5 days, on average, the implied vol is around 22.6. Well, that's the 30-day IV. So sorry, so that's actually not going to help us, because we want to know where that implied vol is on a front month. So let me just go to my IV Theo. We're going to use this. So here's how it looks. So this is going to be a better diagram. So I'm going to explain to you kind of what's going on. So in this payout diagram, it looks, this here payout diagram looks at where the profits and losses are based on the first month expiring, going to parity, and then that earnings month, if the implied volatility is where it is today. But we want to know, where does usually the implied volatility move to, based on how many days left to earnings, right? That's what we want to know. So in order to do that, we have to go to our IV Theo. And this IV Theo is going to paint us a different picture based on where the implied vols tend to go in the 50th percentile. So this is right in the middle. Where are the implied vols usually, with the same distance to earnings? And this is what the payout diagram looks like. So there's a lot of data coming in here, to perform this analysis, because the machine's already recognizing what you're trying to do based on earnings and so forth. And it's painting you on the 50th percentile what that diagram would potentially look like. So you could see that your profits actually extend beyond those 2 points, because the implied vol is expected to be at a different level on January 21st due to the fact that it starts to increase heading into earnings. Is that, if Trevor's on and I'm not setting it up the way he was expecting, let me know, but I think this is where his question was headed.
Trevor, what do you think? He did mention, he asked, why did you select the calls you selected? Was it just by chance? He was asking.
You see, I don't know what he's looking at, so
Yeah.
I had to just assume that. The problem is like, people ask questions, but there are too many nuances and options, right? So
was there any, I guess the question is there any reasoning behind the calls you selected, or?
No, I just wanted to select because he was looking at what I thought was a double calendar spread. I had to select one calendar, right? I had to do two of them. So the two that came into my mind is one above the strike and one below the strike. I mean, sorry, about one above the spot price, one below. But it's up to you. What I wanted to demonstrate is that when you select those strikes, right, you're doing it with in mind having that those strikes are where you think are the sweet spots, right? So I didn't, there's no particular reason I selected these two. I could have selected ones that stretch out further, but I just selected the first two that came up for demonstration purposes.
He's asking, I'm assuming can you, once you have this up, can you check how the spread would respond to different price moves after
Well,
earnings?
that's what this is.
All right.
After earnings. Well, no, because when you're doing a calendar spread, that's what I was trying to point out. So look what's happening here. When you're doing this calendar spread, right? Earnings are going to be January 27th. This strategy will end on January 21st. It's true you'll still have the January 28th options will not expire yet. You will have them, but the January 21st options will expire, right? They'll either be in the money or out of the money, but it's no longer a calendar spread after January 21st. So you're looking at a different risk profile. It's up to you what you want to do there, but you're no longer along a calendar spread, right? So that's important to understand, that you could keep carrying this, but you're going to have a different risk profile. It's no longer a long calendar spread. It's a different strategy, and then you have to evaluate what you have at that time, right? So simulating it going through earnings doesn't even make sense, because this January 21st is gone. It's not going to be there, right? It's over. And you have to understand that about calendar spreads, because if you don't, then you got to go back and read it, because this isn't going through all the way through earnings. This is a pre-earnings, right? But this is more of a pre-earnings play than an earnings play. Okay. Because January 21st, that's it. This strategy is done. You're onto a different strategy. You're still going to have risk remaining, but this strategy is done. Does that make sense?
Yeah, that's helpful.
Okay. Now I just wanted to point out, you see where this stretches out, right? This is assuming here that the implied vols remain the same as they are now. When I go to this IV Thea, you're going to see this stretch out. And the reason behind that is, you see that the potential profit stretch out here. And the reason is that this is looking at what the implied vols tend to do as you get closer to expiration, and that's what they're using, right? So see here, it's saying that this option, this will go to 0. These options will go to a different implied vols. So that's why you're seeing this green area stretching out.
Perfect.
Yeah. All right. So hopefully this helps. Running the earnings on this graph will not make really any sense, because once you pass January 21st, this is already going to look different, right? Even this will start changing, because now you got a different risk profile.
Awesome job, Deemer. We're right up against the opening bell. Anything else for the chameleons?
No, I think I'll end it there. If there are follow-up questions, or if Trevor wants to come on, if he figures out a way, to use his mic, and he has a follow-up question, no problem. But this is the way. Again, I'm assuming he was looking at it.
All right, perfect. All right, everyone, remember the webinar tomorrow, IBKR. You got to register on their site. I put the link into the YouTube chat. That's at 2 p.m. We'll be talking butterflies, I think. Is that correct, D?
Yeah, we're going to do butterflies.
Butterflies at 2 p.m. tomorrow on the IBKR webinar. That we will still have our morning show at 9 a.m. Everyone, thanks for joining us. D, great job as always. Great start to the week, everyone. Bye.
Thanks, everyone. Have a good day. Have a good trading day. Stay safe out there, and we'll